Welcome to Zero Noise. I am Michael Alpha, former volatility trader. I'm here to look at the market intuition, cut through the narratives, and figure out how these cross-asset flows are, actually behaving when you strip away the financial media noise.
And I am Bella Vega, quantum physicist. I am here to anchor the room to the data and probabilities. We are looking at structure, not sentiment. If a narrative cannot be proven in the math, it does not exist in this room.
Exactly. And the explicit objective of this deep dive is to interpret the current cross-asset regime using the provided raw data. We want you to map out exactly where the capital is moving right now. This isn't about guessing, right? It's about observing the footprint of institutional money.
Right.
So here is the spoken roadmap for our analysis today. We are going to start with a macro regime snapshot, look at asset-level signals, tear down the correlation structure, map the systemic risk, check out volatility pricing, jump into regime identification, and end with news and geopolitical risk.
Let's get right into the macro regime snapshot. Over the one-month horizon, the market is exhibiting a classic violent defensive tilt. If you look at the blocks, real assets are dominating, up 5.2%. Fixed income is up 1.8%.
Yeah, and meanwhile, equities are slightly soft, grinding down 0.8% over the month. And then you look at crypto, which is just experiencing a severe drawdown, down 24.4% over the same period.
Validating that narrative against the block-level returns shows a very stark asymmetry. You have the safety of bonds and gold acting as a rigid anchor, while digital assets face heavy liquidation. And what is crucial for you to understand here is
The precision of the selling. This isn't some broad market panic where the correlation goes to 1 and everything just gets dumped.
No.
For you as an allocator, the intuition is straightforward. The market is bidding up duration and safe havens while aggressively unwinding high beta risk.
correct. Capital isn't vanishing from the system. It is actively and intentionally migrating into defensive structures.
Capital is just putting on Kevlar. And to see exactly how thick that Kevlar is, we have to drill down into the asset level signals. We aren't going to read you a laundry list of tickers. We focus strictly on statistically meaningful Z-score extremes.
Right. The statistical tails are absolutely breaking historical norms right now. Let's look at gold, ticker GLD. It is flashing a massive positive 3.4 standard deviations over the one-year horizon and a positive 1.8 Z-score over the 1 month.
The 3.4 Z-score is not a standard fluctuation. I mean, that is a violent, sustained tail event indicating relentless institutional accumulation.
Emerging markets ex-China is highly anomalous as well, sitting at a positive 2.15 Z-score over the one-year proxy. On the other side of the distribution, Bitcoin is the standout negative anomaly at a negative 1.43 Z-score over the 1 month.
And the bonds.
Yes, short and belly bonds are surging. The 7 to 10-year Treasury proxy, IEF, is at a positive 1.35 Z-score for the month, and the 1 to 3-year SHY is at a positive 1.1 Z-score for the year.
Let me stop you right there, because here's where it gets really interesting for anyone listening. We have to explicitly call out what is not happening. You hear about this defensive tilt, the violent flight to gold, the bid for treasuries, and you might assume the underlying plumbing of the financial system is breaking. It is not.
No, it isn't.
There is zero evidence of a corporate credit blowout. If you look at high-yield credit, ticker HYG, it has a completely benign negative 0.14 Z-score over the 1-month horizon. The system is stressed, sure, but credit isn't cracking.
The lack of stress in credit is the defining constraint of this market. If we connect this to the bigger picture and move to correlation and structure, you see what the market is actually pricing in.
Which is perfectly captured in the equities and bonds relationship.
Exactly. Let's look at the math on the equity-bond correlation, specifically SPY versus TLT. The 1-month correlation is a staggering negative 0.99.
Wow.
To put that in perspective for you, that is a massive negative 0.95 drop compared to their 6-month correlation.
A negative 0.99 correlation over a 1-month window is insanely violent. Bonds have abruptly remembered how to be a perfect hedge for equities. And this signals that the market is currently pricing in a growth or policy uncertainty shock rather than an inflation shock.
It is entirely distinct from an inflation shock.
Right, because if this were a pure inflation panic, equities and bonds would be selling off together. They aren't. They're moving in perfect mathematical opposition.
It is also worth noting the equity-China correlation, SPY versus FXI. That remains positively correlated at 0.79 over the 1 month.
So we have a massive flight to safety, perfect hedging in bonds, and pristine corporate credit. That brings us to systemic risk. Are we actually on the brink of a collapse, or is this just orderly repricing?
Let's interpret the percentile context so you know exactly where the boundaries are. When we measure system turbulence using the Mahalanobis distance, it is sitting at the 0.404 percentile with a value of 1.83.
And the threshold for a crisis is what?
The 90th percentile threshold is 3.64. We are nowhere near it. The systemic risk algorithms are absolutely not flashing a crisis. Furthermore, the composite stress index is at negative 0.055, safely below the 1.5 high-stress threshold.
From a trading perspective, the takeaway is crystal clear. The market isn't panicking about liquidity, banks are funding each other. What the market is worried about is growth.
And the copper-to-gold ratio, inverted for stress, is flashing a z-score of 2.21, acting as the primary pressure point.
The copper-to-gold ratio is the ultimate macroeconomic tell. When that ratio crashes, giving us that massive 2.21 z-score, it confirms a growth tension narrative, but without alarmism. Position accordingly. The market is bracing for impact, not currently crashing.
Which is perfectly reflected in volatility pricing.
Oh, this is my favorite part.
Implied volatility, the VIX, is sitting at 19.86, placing it in the 69.5th percentile. But realized volatility, measured by GRCH, is lagging at 12.8. That is only the 49.5th percentile.
That spread is the whole game. The volatility risk premium is extremely wide at 7.06, hitting the 86.4th percentile. My Volt Trader intuition tells me the options market is stubbornly bidding up downside protection. It's pricing in far more fear than the actual daily market movement justifies.
Let me constrain that intuition for a moment. I must remind you that a wide spread is information, not necessarily a trading opportunity. You cannot just blindly short the VIX here, assuming it's mispriced.
Fair, but people are paying a massive premium for fire insurance while it's only drizzling outside.
It mathematically quantifies the market's policy uncertainty premium. It's a highly rational calculation by institutional hedgers. Speaking of structure, let's move to regime identification to see how entrenched these behaviors really are.
Where do the models have us mapped?
Equities, SPY, remain anchored in a mid-vol regime with a 60.2% probability stuck there for 40 weeks. Treasuries, TLT, have just transitioned into a low-vol regime at 62.5% probability, and we are exactly 1 week into this new regime.
That transition risk in bonds is massive.
High-yield credit, HYG, is stubbornly persistent in a low VIL regime, sitting at an overwhelming 96.8% probability for 44 weeks. Gold, GLD, is in a high GH-VIL regime with a 51.2% probability.
The two things that should immediately jump out to you are the transition risk in bonds, since TLT just flipped, and the unnatural persistence of tight credit. HYG has been ignoring the macro noise for 44 straight weeks. No forecasts, no price targets for you here, just an acknowledgement of structural boundaries.
The persistence of that low volatility in credit bridges the gap between the internal market data and the external geopolitics. Let's transition to news and geopolitical risks.
Let's frame this out strictly based on the verifiable event. Give me the facts, I'll give the implications.
Here are the top 3 market-moving developments. Item 1. On February 24, 2026, the U.S. implemented a temporary 10% global tariff with explicit intent to push to 15%.
Why it matters. Injects massive policy risk, premia, and inflation uncertainty into the system. Assets, FX, rates, equities, and volatility.
Item 2. On February 20, 2026, the U.S. Q4 2025 GDP advance estimate signaled a sharp growth deceleration.
Why it matters. Triggers a macro growth scare configuration, heavily reinforcing the duration bid in bonds, assets, rates, equities, and eventually credit.
Item 3. Between February 27 and 28, 2026, a joint U.S.-Israeli kinetic strike decapitated Iranian leadership, prompting an immediate blockade of the Strait of Hormuz.
Why it matters. Officially ends containment policies and structurally embeds a permanent war premium into global energy flows. Assets, commodities like oil and gold, FX, and risk premia.
Now let's map out the forward risk calendar for the next 7 to 10 days. I have 2 specific dates. March 2, 2026. The PBOC removes the 20% risk reserve on FX forwards. The expected transmission channel is primarily through FX and equities.
And the second.
March 5, 2026. China's National People's Congress begins to set 15th five-year plan targets. The transmission channel will route heavily through commodities, FX, and equities.
Let's overlay this entirely into the probability times impact map.
Tariff escalate.
Probability high, impact high. Section 122 tariffs require 150-day renewals, guaranteeing persistent legislative uncertainty.
Gross shock.
Probability medium, impact medium. Copper to gold shows stress, but pristine corporate credit spreads act as a massive shock absorber.
Middle East escalation.
Probability high, impact high. A Hormuz blockade directly threatens 20% of global oil flow with immediate inflationary transmission.
If you aggregate all of these catalysts, it raises a fundamental question regarding how contradictory the data has become across different sectors.
It's completely schizophrenic. Before we wrap up this deep dive, I want to leave you with a provocative thought to mull over. Consider the contradiction we're seeing. We have extreme good deflation in tech and software, actively masking bad inflation in services and tariffs.
The underlying components are warring with each other.
Exactly. And meanwhile, beneath the pristine public credit metrics, those tight BBB spreads sitting in that stubborn 44-week low-vol regime, private credit cockroaches are beginning to surface. Look at the February 27 collapse of the UK lender MFS.
It didn't ripple through public high yield yet, but it happened.
Right. If the Fed is paralyzed by tariff-driven inflation, who bails out the private shadow banking system when it finally hits the public data?
The math strongly suggests the public markets are completely unprepared for a private credit reality check.
And that is all the signal we have for you today. Sharp, analytical, zero filler.
Stay disciplined with the data.